let's start off. Easy question. So what's going to happen to the economy in 2014? What is your forecast? And we are taping this.
Yeah,
we'll play it next year.
Yeah. Good question. No, I think that this is the heart of being a monetary policymaker is actually the uncertainties that you face, but the fact you have to make policy in the face of those uncertainties. And that policy, when you make the choice today, it influences the economy over time. It's not that if we saw inflation running at, suppose we saw inflation running at 3, we can't just go turn a dial and make it go down to 2 immediately. It takes time for our actions to have influence. That means we have to be looking ahead to where the economy is going, which is exactly where your question is pushing me. My forecast over the course of the coming year is not that different from the summary of what the committee released for the projections of the participants in December. So what does that mean quantitatively? I would say growth in 2014 will be slightly faster than we saw in 2013. So in 2013, still don't have the fourth quarter number. We're looking at probably around 2.5%.
Okay.
For 2014, I'm looking for acceleration up to 3%. Now, I'm looking for inflation to remain subdued. I think it'll rise up above the 1% number we're at, but I think we're going to be looking at something below 1.5 in that area. But I think that the hard variable in this recovery has been unemployment, and I think that the decline in unemployment has been very strong, considering how slow growth has been. In the past year, for example, the unemployment rate has fallen by 0.75 percentage point or so, and that decline is despite the fact that growth is around 2.5%, which is close to the long-run average in the United States. Generally, we think that to get declines in the unemployment rate, you'd need to have faster than long-run average growth in order to hire in the workers that are coming online through just population growth, and then take up the slack of the workers who are looking for work. So what we've seen is declines in unemployment that are faster than what we would associate with growth, and I think that we're going to see a little more of that in 2014. I'm expecting that the unemployment rate will fall to 6.5%, which is a little more than what you'd expect than given the growth rate typically expect given the growth rate estimate I've described. Where is this coming from? It's coming from the fact that people are leaving the labor force, so that they're not looking for jobs.
Okay, so this seems like a reasonable forecast, but you have a new Fed chairman, Janet Yellen. Out of curiosity, is this going to make a big change in the Fed?
I think that first of all, I'm very much looking forward to working with my new boss. She was the president of the Federal Reserve Bank of San Francisco when I first became president of the Minneapolis Fed. So we were both fellow presidents together, and then she became the vice chair of the Board of Governors in 2010. So she's been the vice chair of the Board of Governors for the last 3 years. She's worked very closely with Chairman Bernanke in all the policy deliberations, formulation of policy, and in particular, she's been the chair of the communications subcommittee of the FOMC. So she's played a big role in sort of the communication developments that I talked about. I think that there's always differences of style and approach whenever you have a transition, but this is about as much of a seamless transition as one could imagine for a position of this kind.
Okay, so we have this seamless transition. You have your forecast for the economy, slightly higher inflation, lower unemployment rate, slightly stronger growth. But we also have this thing called quantitative easing. And then probably what has become the most popular word, at least in the economic sphere, the Wall Street sphere, tapering. Yeah. So first, just very briefly, very quickly, quantitative easing, just so we're all on the same page. What does that mean?
That's a good question, but I could go on at length, but I'll try to.
Because I want to get to the core of this question.
It refers to the fact that the Federal Reserve is purchasing longer-term assets that have been issued by the government, mortgage-backed securities, and also which are backed by the government, or longer-term treasuries. And those purchases, by taking out those longer-term assets, we're putting up upward pressure on the prices of those long-term assets. That pushes down on long-term interest rates, which people have to buy. So that's what people mean when they talk about quantitative easing.
Okay, so then one more definition, tapering.
So tapering refers to the fact that in September of 2012, the committee announced that it was a program whereby it was buying $85 billion a month of assets. And around the early April or May or June of 2013, there started to be a conversation about the reduction in that flow of purchases. And that reduction was referred to as tapering, because it wasn't going to be 85 goes to zero, it was going to be gradual over time.
So that if isn't it be some point in 2014 where the market could just go absolutely crazy and decide, wait a minute, we don't like what's going on here. In fact, we may not even understand what's going on here. I mean, how to manage this tapering without sending interest rates skyrocketing or the stock market plummeting, or just sort of what happened a period last year in May, where investors are sort of going, what is going on here?
I think that these are great questions about the challenges of communication with all these new instruments that we have, quantitative easing being a great example of that. I think, though, and you always knock on wood when you say this, but I do believe that for the asset purchase program, I think we've done a good job of, in December of this year, last year, December 2013, right. I think the FOMC statement did a good job of articulating a plan forward that would provide some certainty about what the path of purchases was going to be like.
So it's going to be a very gradual.
So my reading of the statement, and it's a statement which is vague enough or ambiguous enough that it doesn't necessarily have to agree with what I'm saying, but the way I read the statement was that as long as the economy evolves according to our outlook and doesn't deviate materially from that, significantly from that, we will continue a pattern of reducing the flow of purchases at every meeting. So we're down to 75. We have 8 meetings over 2014. We would end buying new assets by the end of the year.
So the end of the year is the end of QE.
That would be the end of, as long as the outlook evolves, somewhat sufficiently close to what we anticipate.
Okay, so one of the issues with quantitative easing that I think has caused a lot of puzzlement is, why? So the Fed's balance sheet, last number I looked, it's a little bit around $4 trillion. Now, if we were back in 2005 and I was saying, do you know the Fed's balance sheet is going to be $4 trillion? I think it's a reasonable supposition that we would have skyrocketing inflation, and everyone's been expecting inflation. And the question is, with all these QEs, why haven't we seen inflation? Why hasn't this debased the currency?
So I think that the answer to that is there's a couple of different answers, but I'll give the simplest one, which is that in 2005, we didn't have a power available to us that we now have available to us, which is the power to pay interest on the reserves that banks hold with us. The way that we're financing the purchases of these assets is by creating reserves, which are essentially the deposits that banks around the country hold with the Federal Reserve System. And people would have looked at that creation of those reserves and said, boy, that means there's going to have to be inflation. That's all these reserves. The banks are going to be trying to lend that out to people. That's going to, but by modulating the interest we pay on those reserves, we can effectively have any quantity of reserves that are in the system. Right now, as you suggest, it's north of $4 trillion. And that will not, we can modulate how much the incentive that banks have to engage in lending activity. Now, that's the longer term answer. The short term answer right now is that the reason inflation is low is because economic activity is low, is suppressed and subdued. But why is it that people aren't thinking, boy, if you look at the forecast of future inflation, people aren't seeing, you don't see that there either, that there's any risks there. And it's because people recognize that, boy, we can modulate inflationary forces in the economy simply by controlling the interests that are being paid to on the reserves that the banks hold.
Okay, so let's stick with prices for a moment because, on the inflation side, that's one concern. But there's been a growing concern about a word that we really haven't heard since the 1930s, which is deflation. Now, it's much more, the fear is much more concentrated in Europe. And that's the epicenter of concern. But still, in the U.S. here, as your figure showed, I mean, the U.S. inflation is basically, running below the Fed's 2% target range. And so, are we at a period of time where we could end up in deflation, which deflation is the mirror image of inflation. Inflation is an overall increase in the price level. Deflation, an overall decrease in the price level.
Yeah, so I think that I don't really focus on zero, that is inflation being negative, as being the problem point. I feel that we've made a commitment to the American people to keep inflation at 2%. And that commitment is important because when I borrow money, I want to know how much am I going to have to work in the future to be able to repay that money. And telling me the rate of inflation is 2% tells me something about that. It tells me how expensive are going to be goods and services that I'm going to need in order to pay back that loan. The other side of it, the lender wants to have some certainty about what how much they're going to be able to buy with the money they'll get back from me when I repay them in the future. By telling people that the inflation rate is going to be 2%, they can have confidence about how much goods and services they can buy with those dollars that they're either paying or getting receiving in these contracts. If we have, I think we're failing to deliver effectively on that contract when we have inflation running below 2% for many years now, has been true, averaging 1.5% over the past 6 years. And now it looks like our forecasts are for it to continue to run below 2. We're failing to live up to our contract. That means that borrowers are systematically repaying loans with dollars that are more expensive for them because the dollars are more valuable. That means it's harder for the borrowers to repay those loans.
Okay, so one of the things that's going on Wall Street, and you're just as aware as I am of the commentary, which is, on the one hand, as we do this tapering, this is a sign that the economy is stronger. It's a vote of confidence in the economy. There's another argument that's out there, it's been made very, very loudly, which is saying once you start removing the Fed support to this economy, it starts vaporizing. The stock market is largely on a sugar high because of the Federal Reserve's easy monetary policy. So how do you see the economic impact as the Fed reduces its presence? It reduces its monetary footprint.
I think it's a really delicate question for us. I mean, my metaphors don't run to the sugar high kind of metaphors. I mean, I guess I think of us as being in a situation which is it's a situation where it's still cold outside. When it's cold outside, you should put on a coat, protect yourself, keep yourself warm. Monetary policy helps keep the economy warm when conditions are cold. And there are a lot of people out there who think, boy, this is going on a long time. It's like it's May outside. Shouldn't we be able to take our coat off already? Well, we live in Minnesota. We know that just because it's May doesn't mean it's time to take your coat off. It can still be cold out. And so I think we do have to be really careful about about the process of slowing or reducing the monetary footprint. I think the committee is being very delicate about that. This reduction from $85 billion to $75 billion in terms of purchases means that we're still buying a lot of assets. It means we still have a lot of accommodation in place. With that said, I think the outlook that I had up there, I think points to, both in the inflation front and the unemployment front, points to the idea that, boy, we could actually be thinking about doing more, let alone as opposed to reducing our footprint. It looks like inflation is still running low, unemployment is still running high. Maybe we should actually be thinking about doing more.
And this is going to be one of the big topics of conversation because you have this point of view, but there are other Fed presidents that have very different points of view. So when you're having this discussion and you're having the debate at the Federal Open Market Committee meeting, does sort of Janet Yellen get like 2 or 3 votes? Is it the overriding vote, or how do you? Because some people are saying no, we shouldn't be worrying about this unemployment situation. It's all about inflation.
No, we all get 1 vote. We all get 1 vote. No, so the structure of the meetings is very interesting. I mean, there are the 12 presidents, as I described, all 12 presidents and all the members of the Board of Governors will participate in the meetings, whether they're voting or not. And the way that participation works is each participant speaks first in turn about the economy, and the president will offer some local color in particular on that. And then there'll be a second go-round where each person speaks in turn about policy, about their views on policy. And then after that, there'll be a vote on what the appropriate policy stance is. Certainly, the views of the chair of the Federal Open Market Committee receive a considerable amount of attention in that conversation. The conversation is, but one thing I'll say is, it's not really a debating society. That is, people are typically working on prepared remarks when they come into the meeting. So it's not like it's more a conversation that takes place over time, which is appropriate because we're talking about policy choices that they don't take effect in the next 3 weeks. They're things that matter over the next year or two. So I might say something at one meeting, and in the next meeting, somebody else will say something by response. And then there'll be an ongoing dialogue along these lines for some time. But yeah, then the chair, how the new chair Yellen will influence things will remain to be seen. But certainly, we're very cognizant of, under Chairman Bernanke's leadership, very cognizant of the fact that he is the leader of the organization, and I'm sure that will be true with Chairperson Yellen.
So we have these conversations about pricing, and I like this question. Someone did a fair amount of work to do this, and the Fed's mandate is stable prices. You had this target of a 2% inflation. So 2% compounded over decades is not exactly stable. So the questionnaire, I have a spreadsheet program, and over a 60-year period, the cost of goods will go up by 228%. How is this stable?
Well, I'll first say that even if you don't have a spreadsheet program, you can go to the Minneapolis Fed webpage, and we have an inflation calculator, and you could actually do these kinds of
I use it all the time.
Yeah.
It was always fun to look, what did something cost in 1928 versus now? Yes.
No, I think this is a great question. So let me talk about this, because for me, price stability means what I was describing earlier, that we can have certainty about what prices will be in the future. If we knew for sure that the cost of goods would go up by 228%, a borrower and a lender making a deal now for 60 years from now would know exactly how to write the terms of that arrangement with each other. Because they would know exactly, if you give me $228 then, or $328, then I can go out and buy what $100 would buy today. And then we would know that exactly. So that's what price stability means. I think then the question is, why do you choose 2 as opposed to, the question is, why do you choose 2 as opposed to 0? Why do you choose 2 as opposed to 4? I think the reason we choose 2 as opposed to 0 is because of the problem we're in right now. If you keep the average inflation rate low, that tends to keep the average interest rate low as well, because people want to have a high interest rate in order to compensate them for the inflation that they have to face in the prices of goods and services. So if you had an inflation rate of 10%, interest rates tend to be high as a result of that. If we all remember back to the early 80s, when inflation was very high, interest rates were accordingly high as well. But if inflation is expected to be low, then interest rates will be low, and then you get stuck in this kind of environment we're in right now, where interest rates are at, actually we'd like to be able to make them lower in order to help the economy, and we can't. So that's why we on average, we keep inflation at 2 as opposed to 0. Why do we keep it at 2 as opposed to 4? That's because of the idea that there is a correlation that when you make the average inflation higher, it tends to get more variable. It's harder to keep it stable when it's higher. So that, on balance, has led most central banks around the world to pick a number that's around 2, and the U.S. is exactly at 2%.
Okay, so the economy, the job market, interest rates, what people can borrow at. I mean, the Fed has enormous power. And one of the things that's really come true over the past 5 years is that we've seen the Fed exercise enormous power. So at the 100th anniversary, now we're starting the new century. and we try and figure out what to learn from the past 5 years. What was done right, what was done wrong, what do we really need to focus on? Is the Fed too powerful an institution in a democracy that the Fed can decide that it's going to expand its balance sheet up to $4 trillion, and essentially the Fed is responsible to itself?
No, I don't. I mean, we have a tremendous amount of. These are great questions, and I think it's a very reasonable time to ask them. Partly because of the last 5 years, but partly at a centennial, it's very reasonable to be asking these kinds of questions about the scope of powers that the institution has. I think that it's we've been given a lot of independence by Congress, and that's appropriate because there's been a lot of studies showing that having monetary policy being made with a longer term horizon, a longer term perspective than elected politicians have, gives rise to better monetary policy outcomes, gives rise to the low and stable kind of inflation that we've enjoyed in the U.S. Over the last 30 years, and that other countries have actually borrowed some of our structures, the independence that we have over the last 30 years. You see other countries taking that on. So that's but we are accountable. And I think the way the accountability works is the process we just went through. That we saw the chairman of the Federal Reserve System, Chairman Bernanke, step down from the position.
Right.
And then there's a transition whereby the president appoints somebody new, and that person has to be confirmed by the Senate. The president is obviously elected by the people of the United States, and he has the ability then to choose someone who he views as appropriate for the position, but that then has to be also approved by the Senate, as just happened in the case of Janet Yellen. So that's I see that as being the fundamental connection that there is an accountability that takes place. There's many other forms of accountability, which is why the new chair of the Federal Reserve System, Janet Yellen, can look forward to many days of testimony on Capitol Hill. It's exactly because of that accountability that that we have before Congress. So I think there's many ways in which we are independent but accountable. Many ways in which that's true.
So let's turn to the job market, because inflation, GDP, these things are important, but to most people, what the economy really about is jobs. And you gave a talk a while back, 1979. Paul Volcker gave a famous speech about, it's basically time to put an end to inflation. And for those of you who might remember, back in the 1970s, there was a belief that you couldn't defeat inflation. There were all these books that were being written about inflation as democracy's disease. I don't know if that actually was one, but something like that. So we've seen inflation over the next 3 decades really did come down. And you gave a talk saying, look, we're at a similar period of time, but it's about the job market. So how do you see that playing out?
Yeah, so actually, Carmi, if you could show the pictures of employment, I think this is these are the kinds of pictures that give rise to the concerns that people have about the job market. So I showed you the unemployment rate earlier, and the unemployment rate has been, I think, is a cause for concern in and of itself, but it has been falling gradually. But I would say the unemployment rate, despite the fact that it's been falling only slowly, and it still remains at 7%, it remains too high. It's actually, in some ways, a gauge that exaggerates the improvement in the labor market. So to take that into account, we have to recall what the unemployment rate is actually measuring. So every month, the Census Bureau goes out and asks a sample of households, do you have a job? Then you're counted as employed if you have a job. And if you don't have a job, have you looked for one in the past 4 weeks? And if you've looked for one in the past 4 weeks, then you're counted as being unemployed. And the unemployment rate is the fraction of people who have looked for a job in the past 4 weeks relative to the sum of those people who have either looked for a job and those who actually have one. So that means the unemployment rate can actually be falling for 2 reasons. One, because people find a job, or because they stop searching, because the number of people who are searching for a job in the past 4 weeks, who have not looked for a job in the past 4 weeks, actually grows. Okay. So what we actually see is that a lot of the decline in the unemployment rate that we've seen in the past 4 years has come about because of the fact that the number of people who are looking for a job has fallen, not because there are more people employed. And the way we can see that is simply by looking at the fraction of people over the age of 16 who have a job. That's called the employment population ratio. That is basically, I think, basically the same as it was 4 years ago in October 2009. Okay? There's been virtually no change to that. Now, there is a gloss on this. Some of this is due to demographics. So the fraction of people who are the baby boomers, that group of people that's very large is going to be moving more and more. They're going to be into retirement age, and we'd expect that the employment population ratio to fall for that reason. So if we can see the 25 to 54 group, we see a little more improvement if you focus on the fraction of the people who are age 25 to 54 who have a job. You see, again, sharp fall during the recession, but very little recovery. Some recovery, so there's a little bit going on there. All of this might make you feel very depressed about the state of the U.S. labor market. But the good news on this is what the picture I showed you earlier is about inflation. What you'll hear a lot of people point to when they see these kinds of pictures is, this doesn't mean we have a structural problem with unemployment, with employment. That we can't find jobs for these folks. And the answer to that is, if that were true, then you'd see businesses bidding with each other only for the people who currently have jobs. And you'd start to see wage pressure start to develop. You'd see upward pressure on wages, and that would start to show up on inflation. Okay, so costs would go up for businesses, and you'd start to see that in terms of inflation. That's not what's going on. Inflation is, as we talked about, remained low, and that's because businesses are not finding workers to be scarce. So that means that why is this good news? It means that there's ways you can try to ameliorate this using monetary policy. If inflation was at 2% or above, boy, not much you can do with monetary policy at that point, because you try to stimulate the economy using monetary policy, you're just going to be creating undue amounts of inflation. But given that inflation is running as low as it is, we can provide that stimulus that will lead businesses to want to go out and hire more workers. That will not lead to inflation because, well, undue amounts of inflation, because as we just talked about, inflation is still running low, and we can start to get these numbers up. So that was the theme of my talk. And when people talk about structural, it's not enough to just look at these pictures and say, look, they look flat. That's like looking in the 70s and say, boy, inflation's going up. Nothing we can do about it. Here we see these numbers looking flat, and we can say, oh, there's nothing we can do about it. No, you've got to think about what the costs of action are. And if the costs action for me as a monetary policymaker are all about inflation, that's remaining low. Well, I have room to work.
In terms of having room to work and keeping rates low, keeping monetary policy easy, does that also have an effect on the underemployed? When we have because we always talk about the unemployment rate and employment population, but there's a lot of people that are just underemployed.
I think this is a great point, and so even among the people who have a job, if you focused on the people who are working part-time but would like, and when they're asked, would say, would you like to work more hours, but the reason you're working as little as you are is because you can't find more hours to work. That number is surprisingly, disturbingly high relative to what it was in 2007. I mean, I think we should be looking at all these measures of labor market health, and they're all pointing to the same story, which is, I think, that the labor market has room for improvement. Then the question is, can monetary policy be a source of that improvement? And the answer is, as long as inflation is remaining as low as it is, yeah, we can do more to help. And so we can't just look at what's going on in the labor market to decide whether we can be of assistance. It's what's going on the inflation side matters a lot as well.
And can monetary policy have an effect for, if we're looking out over, say, the next 3 years or so, monetary policy have an effect on the long-term unemployed, which has been a big part of the discussion going on right now. I mean, people have lost their job, they really can't find a job, and there's a harshness to our labor market. Is the longer you're unemployed, the less likely you are to get employed, even if you really want that job.
So these are, again, this is certainly a very disturbing feature of this recession and then the slow recovery has been the increase in the long-term unemployment rate. But it is really important when you look at these numbers, it's not the same people in the numbers every month. And so what do I mean by that? So if somebody who's been unemployed, if you look at the group of people who've been unemployed for over a year, their rate of finding a job is disturbingly low, but it is still positive. And so there's actually a relatively large fraction of them are finding jobs. Why then, if that's true, what I just said is true, why is it that the long-term unemployment remains so high? It's because the people who have been unemployed for less than a year are finding jobs at so slow a rate compared to what was true, say, in 2007. If we could actually get down, increase the rate at which people who are been unemployed for less than 6 months, get it back to normal, get that back to where it was in 2007, we would actually get the long-term unemployment rate down very rapidly. And the reason for that is they find jobs sufficiently rapid to clear that out. What's happening is you're backfilling from the people who have been unemployed for less than a year. If they don't get a job, then they become unemployed for longer than a year.
So what are the limits of monetary policy? I mean, in terms of affecting the job market, I mean, you have some powerful instruments. You've been doing the quantitative easing. You can keep interest rates down. You have a moral suasion effect that you have in the market. I mean, there's just a lot of ways that the Fed can exercise influence over the economy, and yet this job market really is not that good. So what is limiting the impact?
I think the key barrier for monetary policy is the so-called zero lower bound. And what that refers to is that we can keep interest rates low, but we can't make them lower than they currently are. Right now, the interest rate is, the Fed funds rate that we typically target is being targeted between 0 and 25 basis points.
Right.
Cash pays an interest rate of 0. So if you we can't make that go below 0.
Can't have a negative interest rate that way.
If we had a Fed funds rate of 2% and we were facing this outlook, I think our conversations, you and I would be having, would be very easy. You'd be saying to me, you should lower the Fed funds rate. I'd be saying, yeah. And so that would be, the challenge right now is the fact that the Fed funds rate is and since the December of 2008 has been at 0. We have not been able to lower it to provide the kind of stimulus. And so we've been, quantitative easing sounds big because people talk about all these big numbers, a dollar is floating around, but you're trying to swing huge markets. So your ability to influence these yields are actually, we talked about an impact in terms of impact on interest rates. It would sound a lot less impressive than those big $4 trillion numbers make it seem.
Now, there's also, I mean, some of your colleagues, other Federal Reserve Bank presidents, some people in Congress, some people on Wall Street who are saying, look, what are you doing talking about this unemployment? It's all about inflation. That's all you should be focusing on.
Yeah, so this is a comment that we'll often get, and I think it's a very interesting question, a very interesting comment about what should be our goals. So we have 2 goals: price stability and maximum employment. If Congress doesn't like the fact that we have 2 goals, they can change.
They change the rules.
Yeah, they can change the rules. We give them, but they shouldn't say to us, "We've given you 2 goals. Please ignore one of them." I don't think that makes sense. So we have 2 goals. We have to.
That's never stopped Congress before.
But if we have, I didn't say that. We have. But there's, I think, an interesting economic question. Many central banks only have one mandate. Should we just be focusing on price stability, on keeping inflation at 2%? I think it's an interesting question. Lots of arguments, I think, in both directions. It really does not matter right now for the stance of policy, and the reason for that is, if you're an inflation targeting central bank, and you're sitting there with inflation running below 1, expected not to get back to 2 for years, you should be adding accommodation. You should be easing policy. So this issue about should you have 2 mandates or 1, it's a very interesting intellectual question, and one that I certainly, I understand why Congress might want to rethink that at various points in time. This is not the time where that tension manifests itself, because if you're an inflation targeting central bank, there's an argument you would be doing more than what we're doing right now.
Okay, so let's stay in Washington, D.C. We're going over to Capitol Hill. What fiscal policy proposal do you think would have the most positive effect on employment in 2014? I mean, is there something that Congress could do that would help out?
I don't think along those lines. There's many things in the world that take place that influence the path of the economy. And we, as monetary policy makers, have to make policy taking those as given. With that said, I think that there have been some very positive developments in the fiscal policy front in terms of, I think we have more certainty about the path of fiscal policy, near-term certainty about the path of fiscal policy over the next year or two. I think that's going to be positive for the economy. There's a longer-term uncertainty, but this longer-term uncertainty has been there at least I'm going to say for decades, because I think it's been coming at us for that long, which is a demographic issue that we have the baby boomers who are going to be hitting retirement age. We've made a lot of commitments to them societally in terms of providing medical care, in terms of Social Security for them. The pool of people behind them is smaller, that's going to be working to provide the funds for that through taxes. So that makes a gap between the tax collections and the benefits being paid out, the transfers being paid out. That gap will be a longer-term issue for the United States. By longer term, I mean typically forecasts start to see that being highlighted in the 2020s. And trying to resolve that, I think, is that would be a real positive, but that's obviously very challenging, I think, from a political standpoint. But yeah, over the last couple months, I think there's definitely been a reduction in near-term fiscal uncertainty. That's been a positive.
So, taking also, sticking with the longer term, maybe not as long term as entitlement reform, but in the longer term, bubbles. Now, we went through a period of time with bubbles, and bubbles, we had the dot-com bubble that burst, and that had an effect on the economy. Obviously, we had the housing market bubble that burst. That had an enormous effect on the economy. So, when we're looking ahead, I mean, have you figured out this bubble thing? Have you figured out what is a bubble? And then, if you got one, how do you deal with that, and does it worry you?
Wow, those are a lot of good questions. If I were still an academic, I think those questions could fill the rest of my career pretty readily. And I say that only partly jokingly, in the sense that these are questions that have actually preoccupied academics for a long time, and yet I think we really, as monetary policymakers, we really sort of need answers fairly soon on some of these questions. Yeah. So I don't like to use the word bubble. I think that really the question for us is about the future possible outcomes for prices. So when housing prices were high in the mid-2000s, this focus on whether they were too high, I don't think is really the right question. It's really about what are the risks of a fall in prices, and what would such a fall, what impact would that have on financial markets? I have to say we're much more cognizant of watching the financial sector for those kinds of risks and the effect of those kinds of price changes on the economy as a whole than was true before the crisis. I think there's a lot more work going on in the Federal Reserve System along those lines. How monetary policy should play a role in if you see prices being too high or looking high, and then you're worried about a fall in prices, what should that mean for monetary policy? I think that's still a very challenging question to sort through. Do you really say, okay, we're going to be willing to have hundreds of thousands of people out of work because asset prices that we're worried about the risk of an asset price fall? I think that's really the tension we're going to have to struggle with. I would prefer that the Fed has been given a lot of powers, and other agencies have been given a lot of powers under the Dodd-Frank Act to do a better job in supervision and regulation. That's where I see the real gaps in the mid-2000s were in that sphere. I think we should be doing a better job on that, and I think Dodd-Frank is led us to be able to do a better job on that.
And then also, not to get too dark, but we have this enormous global derivatives market. And there's lots and lots of things going on. And you could have bubbles going on, and it could be extremely opaque. So how does the Fed coping with this derivatives market, which is global and oftentimes tailor-made, and you don't kind of know where is the chain of responsibility.
Yeah, I mean, I think these are the ongoing challenges. I think the key is to look at the institutions that you see as being vulnerable, try to make them as transparent to your visibility as possible, and see that they are not vulnerable to the kinds of risks that you're describing. That's the best you can be doing along those lines.
So that's why the focus on capital in the banks.
Trying to keep the banks. If you have large financial institutions that you're worried about the risk of their failure, then the way to deal with that is by having them hold capital. Then it takes a bigger shock to sink that boat. On the other side of that, you ask them questions to say, suppose the worst was to happen and you were faced with failure. How can we take out the pieces of your operation that are critical to the operation of the economy and keep them running? So this is the so-called living will process. It's part of Dodd-Frank as well. So there's if suppose the worst happens, what would we do kind of a situation, and then also trying to prevent the worst from happening. Both of those are in Dodd-Frank, and both are being followed by regulators.
So in this question, this is not about the worst that's happening, but I'm sure you've come across it a lot, where these low interest rates. You take a look at your savings account. I mean, people aren't getting anything of their savings, and a lot of elderly, a lot of people nearing retirement, baby boom generation, and are these low rates hurting senior citizens more than the low rates are helping the home buyer? Because it seems like there's a lot more senior citizens out there than there are potential home buyers.
Right. That's a great question. I mean, let me talk about this in two ways. First, I think a lot of people think about the Fed as creating a low interest rate environment, when in fact, I see us as being responding to the low interest rate environment. We have I just showed you the outlook for unemployment and the outlook for inflation. And those are inflation's running too low and unemployment's too high, even though we have interest rates as low as they are. And why is that? It's because of the fact that there's a much bigger demand for saving and for safe saving than there was 5 or 6 years ago. So people are scared because of what happened in 2008. People want to have instruments that are insulated against those kinds of risks. So there's a big demand for safe assets, and fewer assets are viewed as safe than what was true in 2007. People thought of a wide range of sovereign debt as being safe in 2007. That's no longer true. People thought of anything backed by U.S. residential land, any kind of mortgage-backed security was viewed as safe in 2006 and 2007. That's no longer true. So the supply of safety has decreased, the demand for safety has gone up. That pushes down on the interest rates. So the Fed is just responding to these fundamental forces out there in the economy. Now, if you're a senior who's saving, you're trying to engage in an economic activity that everyone else is trying to engage in now. Right? If you were a saver, now you're facing tons of competition for the very thing you want, which is safe dollars, safe saving for the future. I mean, you're going to get a low return on that activity. Now, part of this question is, maybe you're going the wrong way in terms of stimulating the economy by keeping interest rates low. Low interest rates work to stimulate in so many different ways that this question focuses on one aspect of it. The low interest rates help people buy homes. But low interest rates also stimulate the people to go out and buy homes. That pushes upward on home prices. That it's also pushing upward on stock prices. That makes people wealthier. They have more money to spend. By and large, the fact that you're getting a low return on your savings account on the margin makes you think to yourself, maybe I could spend that money as opposed to save it. That's the fundamental force that's driving, that makes low interest rates stimulative for households and for businesses. Yeah.
Now, couldn't you engineer it where you get high rates on our savings and low rates on our loans? I mean, now, wouldn't that be a good Fed policy? All right, one last question, and I'd like to go back to the job market, because a lot of us, that is obviously, as I said, what the economy is, the job market. So, and back to the structural unemployment, I mean, do we have a workforce that is on track, particularly speaking about education. You know, we have a workforce that is on track, toward helping this economy grow, or are we focusing too much on a college education, not enough on college education? But how does this trend about, you hear employers want a more educated workforce, but there's kind of a big question, okay, so what does that really mean?
Yeah, I mean, and that's the private sector. That's up to them to determine. I would say that, I think these are I'm not an economics of education expert, so I want to be careful in what I say on this. But and there might be ways in which we could be doing better in terms of what this question asks, in terms of maybe there's too much focus on college. The only thing that gives me pause here is I think we should be setting high standards for ourselves and for our young people. We're not just competing with ourselves, we're competing with the world out there. And you ask yourself, are the Chinese in Shanghai sitting and thinking, are we putting too much emphasis on college? And maybe we shouldn't be educating our people as much as we are. And I'm not there, so I don't know the answer to that. But my guess is the answer is they're not saying that. If they're not saying that, they're educating their people. That's who our young people are going to have to compete with down the road for jobs and for good jobs and for high wages. We want to get our young people to be in the best possible place for that kind of global competition. I think in the last 20 years, you look at the arc of educational improvement in the United States, we see improvement, but it's not as rapid as it was in the previous 20 years, and it's not as rapid as the countries we're going to have to compete with down the road, including our neighbor to the north.
Well, I don't know about you, but I could keep going, but
Yeah.
we've run out of time.
Okay.
And I think I speak for both of us. Thank the audience for coming.
Thank you very much.
And thank you
Absolutely.
very
Thanks
much
for the
for those who submitted questions. It's been great.